Welcome back to SRC Concept, and this is the second lecture where you're going to learn about the advanced application of the IFVG. First off, we all know by now what a fair value gap is. In the simplest term, a fair value gap is like supply or resistance, even though we are not looking at it that way. But it does the same thing, or it means the same thing as supply or resistance. Just like any other PDR, the bullish fair value gap is like support, the bearish fair value gap is like resistance. Okay. For instance, when we have a bearish fair value gap like this, we are waiting for price to return back to that fair value gap, so we go short, right? And when we have a bullish fair value gap, this is a bearish. When we have a bullish fair value gap, we are waiting for price to trace back, so we go long. This is how we normally trade the fair value gaps. Then, we already understand this. But then again, there are certain times you mark out the fair value gap, either bullish or bearish, and price will not hold as a bearish. If it is a bearish fair value gap, price will invalidate the fair value gap, and then after then, price will continue going up from there. I know it happens to you and it happens to you regularly, something like this. Or vice versa, if it was a bearish fair value gap, if it is a bullish fair value gap, instead of holding price to sell, rather, instead of holding price to buy, rather it will hold price to sell. So now, an inversion fair value gap is like a support becoming resistance, or a resistance becoming support. It's like peak. What I mean by a support becoming resistance, let's say we have a resistance level here, like here we have resistance, right? Every other trader that trades resistance is expecting price to come back to exactly that resistance level and continue selling. But at times that doesn't happen. We come to see something like this, price breaking out of that resistance range, and then it will return back to the resistance level. But instead of selling, it will buy from that resistance zone. Vice versa with the support level. That is what the retail concept traders call brief, or support becoming resistance, or resistance becoming support. So same thing with fair value gaps. Bearish fair value gap can become a bullish fair value gap. A bullish fair value gap can become a bearish fair value gap with context. Now, what I mean by context is, where is price going to? Where is price heading to? That's number one thing we always consider. If in your high time frame, you are expecting bullishness for price to continue going up, thereby, if price happens to, let's say, we have a kind of sell-side liquidity right here, or a high time frame PDR, but let's put it as sell-side liquidity. Let's say we have a sell-side liquidity right here, and let's say price happens to sweep that sell-side liquidity from your higher time frame, and then let's say this is what we have. Let's say this is our higher time frame, right? And we have a sell-side liquidity right here. So if this is our high time frame, let's say this is previous day's low, or let's say previous session low, or any significant important sell side, and then we happen to see price taking that sell side liquidity, right? So we know contextually, in a bullish market, we are expecting to see something happening like this. In a bullish market, we want to see price taking sell side, and then you continue looking for buy. That is ideal for a bullish setups for a bullish market. So let's say we have this on our high time frame. Market forge this sell side liquidity. That means we are looking for buy. So if you are looking for buy, you are not going to consider any bearish PDRA. Any bearish PDRA that is coming on that way is going to be crushed, is going to be invalidated, because the market prioritizes liquidity. The market prioritizes what the high time frame is commanding it to do. If the high time frame is commanding the market to go up, let's say we have a draw on liquidity right here. Let's say we have a draw on liquidity right here on the higher time frame. If the market is coming for this specific liquidity, then what will happen is any bearish PDRA that come in the direction of that liquidity is going to be crushed, is going to be inbound. So now, this bearish fair value gap, as this happened, contextually, as this happened, we're expecting this bearish fair value gap to not hold price. And what we are expecting is price to invalidate this bearish fair value gap and then to come back to the bearish fair value gap, but now not to hold a sell, but to hold price to buy and go up towards that draw on liquidity. So that is what we have as inversion. So initially, this is supposed to be a bearish fair value gap, but because of this context, we are bullish, we are looking for buy. This bearish fair value gap is going to, like, even ahead of time, you know, is going to be invalidated. Price is going to trade over it. Instead of holding price to sell, now it is going to hold price to buy. That is like support becoming resistance or resistance becoming support. So now it will change from fair value gap into inversion fair value gap. This is what we call inversion, and this is what inversion looks like. Likewise, in a bearish market, this is in a bullish market, right? In a bearish market, let's say we have something like this in a bearish market. So let's say this is a bearish market, and let's say price is heading towards a specific draw liquidity on our high time frame. Let's say we have our draw liquidity right over here. And whatever the high time frame says, that is exactly what your lower time frame must do. So let's say you come down to your lower time frame and you are looking for short. If you are looking for short, and then you happen to spot a fair value gap like this, this is a bullish fair value gap, right? This is exactly a bullish fair value gap. So in a bearish market, a bullish fair value gap is going to be ineffective in the sense that it is not going to hold price to buy. Rather, it is going to be turned into an inversion. Instead of holding price to buy, we don't trade pattern, we don't trade PDRs only. We trade contextually and logically based on what our high time frame is telling us. So prices don't just going to come to any fair value gap and hold and start going up. No, because our bias, the directional bias is sell, and we have a drop on liquidity under that bullish fair value gap. So this bullish fair value gap is not going to be effective as bullish fair value gap. Rather, price will penetrate into that bullish fair value gap. And once we have candle closed, then it now turns into inversion. And then the market will return back into that fair value gap, and then it will sell up of that fair value gap. So now, it has now become an inversion fair value gap, no more bullish fair value gap. So now let's go into the chart and find some examples. Now let's look at what happened here. You can see this is BTC USD and this is our daily time frame. You can already understand the order flow. Price has been bullish since March, and then you can sense the reversal formation happening here. But let's look at where price was coming from. Price was coming from this leg. We have a bullish run, and you can see multiple PDRs, bullish PDRs be respected, right? Pair value gap here and order block here. And then before we start facing this reversal, we have this buy side liquidity, right? Price forged this buy side liquidity, right? So we have this BUSL, right? So we have this buy side liquidity. And then looking at this, you can see we have a structure. We have this high, this low, and this high. And you can see the structure right here. Price traded below this low. So price broke this structure. And immediately we saw this break of margin structure. Then we can understand that we have a reverse and price is going to retrace back into this range. And then if we use our Fibonacci and take our range, delay range, right? You can understand price is retracing back into discount level, right? And then that retracement is being confirmed after we saw this structure. On the daily time frame, we have this bearish breakout structure. So we can understand the bias is sell, and this is off day in my community. I posted my bearish bias. So you can understand that the bias is sell. It's short. Price is coming down back into this range. Probably you can see price mitigating this fair value gap again, or coming to this order block, or even coming as low as 70,000 to take out this sell side. But for now, our bias is bearish. We are looking for sell. So you can see from this leg, we have this fair value gap. This used to be a bullish fair value gap. Had it been to say we are continuing to look for buy, then definitely, if we are still bearish, then definitely we will buy up of this fair value gap. But because the narrative has changed, this time we are bearish. That means we are expecting for drop. So what is this now? This was supposed to be a bullish fair value gap, but it is now an inversion on the daily fair value on the daily time frame. So it has now turned into an inversion. This is an inversion fair value gap, which means we are going to be using this to short. And let's say we continue shorting from, you see, price drops, taking this sell side, and you can see we have sell side here, which I can say we have relative report high. So we are expecting the drop to continue happening up of this inversion. This is a daily inversion. So now when we go to our intermediary time frame, that's the 4-hour time frame, the price has responded nicely off of this inversion. You can see we have this order block. I mostly use the body, right? We have this bearish order block, and you can see how price, precisely responded from that bearish order block from 4-hour time frame. This could be a very nice short-term trade to SLB, and if you target this low, you have a very clean 5 weeks to ratio, right? If you target this low. So you see, we have this daily inversion, and on 4-hour time frame, you can see a very clean setup. But then again, let's go down to another lower time frame. Let's go down to 1-hour time frame and start looking for an entry within that 1-hour time frame. Okay? So you see, on 4-hour time frame, we can still understand that we are bearish, and at least we are targeting price to come to the sell side. So on a bearish market, we can mark out buy side liquidity. If price forge that buy side liquidity, it is something we would want to see. So this should be a total soak, at least a buy side liquidity. And on a bearish market, we would like to see something happening like this, and then structure, and then we continue shorting, right? So now let's see what happened. Okay, so you see, price forged this, right? Price forged this buy side liquidity Look, I just want to call your attention to something. Before price forged this buy side liquidity, what do you have right here? You have a structure, this low, this high, this low. And before then, what do you have? You have a bearish fair value gap right here. But because the narrative says we need entry confirmation, we need confluences before we continue taking trade, that is why this liquidity is so significant that the market cannot go without taking it. This bearish fair value gap did not hold price, and the market have to come and take this, and we create sales to do so before it continued dropping. So that's exactly what happened. Market took this, and you can see before the market take that, what do you have right here? You have this structure, swing low, high, low. A lot of traders will be longing here, they will be buying here. After this structure, they will be buying this fair value gap. So this is supposed to be a bullish fair value gap. But what will happen? Because we are bearish and price take this buy side liquidity, we have this total soup. Then this very bullish fair value gap is now going to turn into an inversion fair value gap. So it is now turned into an FVG. And since it turned into an FVG, I'm using this FVG. I'm using this inversion to sell. And how do I use this inversion? I use it two ways. First off, I want to see candle closing completely, not only wicks. Like when you study this first candle, second candle, you see it's wicks that close the fair value gap. What I want to see body closure like this. And after the body closure, I have two ways of taking entry into inversion. I can take an entry when the next candle pop up, and my stop loss should be right here or sometimes around the high or the body of the inversion candle, depending on how comfortable you are. But I will not set my SL here. It is too or realistic, or I say it is like mental SL if I set it there. So then I will be targeting, let's say, a P3 SWAR ratio, the G3R or the next row and liquidity or whatever. Let's say I'll be targeting this. Or let's say my SL is here, realistically, and I'm targeting this. So now I have two options, or to wait for price to right back to the inversion and then to take an entry. This is like extra confirmation. But anyways, when you backtest, you will find which one works better for you. You can take entry after the next candle closure. After the candle closure, then the next candle you can take entry on it. Or you can wait for price to retrace back into the inversion. Like this is what I'm talking about. You can take entry here. This is the candle that closes the inversion. You can take entry here. Or you can wait for price to return. So you see, this is what I am talking about. I'll be taking entry. The moment this candle closes, I'll be taking entry. And I'll be targeting the opposing liquidity. So this is a typical example of inversion. We have seen it from the higher time frame. How you make use of the inversion, like to tame your high time frame key level. The bias is already bearish when I explained on the bearing. We are looking for sell, and we have seen the level we are expecting price to drop into a discount level on the bearing. So you see, this has delivered 5% of this inversion. So now come to think of it again. A lot of traders will be going long upon seeing this structure, this bullish structure, and upon seeing this bullish fair value gap. But we already understand the context, the direction the market is going. So we know this is not a bullish fair value gap, but rather it will be an inversion, that is a bearish fair value gap ladder. And that is exactly what happened. Price closes with this candle below the inversion, and it retraces. As it closes below the candle, then you take your entry at the next opening candle and your stop loss realistically, because you will not be expecting price to come and do something like this and drop. That means it is not respecting the inversion. So the highest you can set your SL is around the body of the inversion candle. That is this. or a little bit at the closing of the inversion, that is around the level I set mine here, and you'll be targeting the opposite liquidity. Either this a fixed risk reward ratio, we are coming to risk management, where I will explain what is better for you, and you can test and see what is good or what is not good for you. Okay, this is a typical example of what an inversion fair value can look like. And this is daily time frame. And you can see Nasdaq consolidated for a very long period of time before finally breaking out of the consolidation. And you can see now it took this relative equal loss, this sell-side liquidity. So obviously in a bullish market, when we see consolidation like this, we know the power of three is in play. This is accumulation, and the drop here is manipulation. And manipulation ends particularly when we see something tangible like market taking another liquidity, especially now that we have two relative equal lows. These are very, very strong liquidity levels that the market come and take. So right here we are looking for buy anytime. Anytime the market can buy, perhaps it can dip down into this sell side again, or this should be enough for the market to reverse. So right here, what we do is we go to lower time frame and we start looking for possibilities of price going lower. On the 4-hour time frame, all I can see is price came here and took another sell side. So for me, this is something reasonable to start looking for buy. So now let's go to 1-hour time frame again. Since the daily time frame almost confirmed, and the 4-hour time frame also show us the intent that the market is likely about to start going up. So I know right here, a lot of traders will be looking for short, and they will be considering this as structural, like price return back into this fair value gap again, and then they have structural swing high, swing low, swing high, and displacement. So they will be looking at this fair value gap to short. But what I'll be looking at here is, this is not a fair value gap. This is a potential inversion fair value gap, because I have already explained why. But I want to see that reason to go long. So another thing I would like to show you is, when you have two fair value gaps like this, you can make use of the two as a single inversion. Because when you come to 2-hour time frame, this is what you will see. So on 1-hour time frame, you can make use of the two fair value gaps, because we have a small fair value gap here and this extra large fair value gap. So right here, I will not be expecting to sell. Rather, I would be expecting this to turn into an inversion. Something like this, and then we continue going up. Okay? And let's see what happens. See, price took the liquidity, and let's see if it will dip here. It didn't dip. So as price took this liquidity, what happened next? Price take this low again, and then price rejected off from this swing low between this candle base and this. So as this candle closes, then you have two options. You see, you can take your entry at the opening of the next candle, and your stop loss to be around here. Or you can wait for price to retrace back into the inversion, and you can target the opposite liquidity, like right here you have this buy side liquidity. So you can take the entry at exactly this candle body closure. The next candle is your entry, and target the opposite liquidity or your pitch risk reward measure. Or you can wait for price to retrace. So you see right here what happened is, price retrace back into the inversion level. This is the inversion. So I said you have two options, right? Or you wait to see price coming back to the inversion level, and then you're taking your entry within the inversion, something like this. And then you target the opposite liquidity. If you are targeting the opposite liquidity, then it will be at least around 6R. So now between 2 and 3, the two ways to trade the inversion is left for you to choose. Are you going to move with the aggressive way, the first one I shown you? Or are you going to wait when you see an inversion? Are you going to wait until the market retraces back into the inversion before you take your trade? And then this is how to use it in the advanced way. And then because this level is strong, you can see how many times the market come back again and again into that inversion level. And then finally, it delivers towards our target. So this is how you use the inversion fair value gap in the advanced way. You happen to see a fair value gap, but because you already know the direction of where the price is going. So the moment you see that a lot of traders will see that fair value gap, but you are not seeing the fair value gap. You are seeing an inversion even before it happened. This is how you turn an inversion with precision, and then exactly this is how to trade. So that's the end of today's lecture. And let's meet